Getting crypto taxes buttoned up to thrive in 2026. Let me preface this with a hard truth. Most crypto investors and entrepreneurs think they can figure out taxes later, but the IRS, powered by AI, is already years ahead. And if you're not buttoned up now, you're setting yourself up for penalties, audits, and lost opportunities when the next bull run hits. 2026 is right around the corner and it's coming fast. And the IRS is watching every crypto move you make. If your crypto taxes aren't buttoned up from the past, you're setting yourself up for penalties and audits and lost opportunities in the future. Let me tell you why you should trust me with something as important as your crypto tax strategy. I'm with Numeratus, and we're not your typical accounting firm. While most firms are still trying to figure out what DeFi is, we've been specializing in crypto tax strategy, compliance, and audit defense for some time. We've helped investors and entrepreneurs get compliant and save thousands before their next tax crackdown. We've successfully defended crypto tax positions in IRS audits when other firms would have just folded. We've helped clients restructure their crypto activities to minimize taxes while staying completely compliant. Here's what most people don't understand. Crypto tax law is so new and complex that 90% of accountants are just guessing when it comes to proper reporting. They're using outdated rules that don't apply to digital assets, or they're just scared of the IRS and they won't help you optimize at all. We built our practice specifically around these complex crypto tax solutions. We know the current regulations. We understand the documentation requirements. We have seen every type of crypto tax scenario you can imagine. If you're watching this, you probably have crypto gains that you need to report, or you're planning to make serious money in the next bull run. Maybe you've been putting off dealing with your crypto taxes. Maybe you're worried about what you owe or what you might have missed in previous years. Here's what I'm going to show you in this video: why 2026 is a critical year for crypto taxes, the mistakes that trigger audits, and most importantly, the exact steps you need to take to get buttoned up and thrive in the next bull run. But here's what's really going to shock you. The biggest threat to your crypto wealth isn't market volatility. It's the AI-driven tax enforcement that's coming. And most investors have no idea that they've already been on the IRS's radar. So let me show you exactly what's happening and how to protect yourself. So here's problem number one: the AI audit wave. The IRS already knows. Let me tell you what's really happening with crypto taxes. A client of ours, let's call her Maria, made a fortune in the last bull run. She thought she could figure out her taxes later. She was busy trading, making money, and didn't want to deal with the complexity of crypto tax reporting. But when the IRS's new AI system flagged her for underreporting, she was hit with penalties, interest, and a multi-year tax audit. She almost lost her right to trade in the US. What she thought was a deal with a later problem became a nightmare that cost her tens of thousands in penalties and legal fees. Maria isn't alone. The IRS is using artificial intelligence to flag underreporting, fictitious structures, and missing forms. And here's the scary part: the AI is getting better and better every single day. Do you think the IRS doesn't know about your crypto transactions? Most crypto investors think they're flying under the radar, but the IRS already has your data. Here's what's really happening. The IRS has been building an AI system that analyzes blockchain data, exchange reports, and transaction patterns. They can see when you're underreporting. They can see when you're using fictitious structures. They can see when you're trying to hide income. And with the new 1099 DA reporting requirements, exchanges are now required to report your transactions directly to the IRS. There's no more hiding. The IRS knows what you did, even if you didn't report it. Now, despite what you've been told, AI audits are just the beginning. There's another compliance requirement that's catching everyone off guard. Problem number two: the 1099 DA trap. New reporting requirements. This is where crypto taxes get truly complicated. The IRS has rolled out new reporting requirements, specifically the 1099 DA form, that require exchanges and platforms to report your digital asset transactions directly to the IRS. Most people don't even know this form exists. But here's the problem. If the exchange reports your transactions to the IRS and you don't report them on your tax return, you're automatically flagged for underreporting. We've seen clients who thought they were safe because they didn't get a form, but the IRS already had their data and they got flagged for underreporting and faced penalties. Here's what makes the 1099 DA so dangerous. Exchanges report your transactions directly to the IRS. The IRS uses AI to match your reported income to what exchanges report. Any mismatch triggers an automatic flag. You're guilty until proven innocent. The burden of proof is on you. Are you tracking every single crypto transaction so you can reconcile it with what exchange reports to the IRS? Most crypto investors aren't, and they're setting themselves up for audits. But after learning the fundamentals, there is one thing that people completely neglect, and it is something that should be one of the most important things to you when dealing with crypto taxes. And it's understanding the complexity of different transaction types. So problem number 3, the transaction complexity problem. Every move is taxable. This is where most crypto investors make their biggest mistakes. They think crypto taxes are simple. Buy low, sell high, report the gain, get taxed. But the reality is there's far more complexity. Every single crypto transaction is potentially taxable. Trading one crypto for another is a taxable event. Using crypto to buy goods or services is a taxable event. Staking rewards is a taxable event. DeFi yield farming is a taxable event. NFT sales is a taxable event. Airdrops is a taxable event. Hard forks, potentially taxable event. Most people don't realize that even swapping one crypto for another is a taxable event. They think they only owe taxes when they cash out to dollars, but the IRS treats every crypto to crypto trade as a sale of the first crypto and a purchase of the second. If you've been trading actively, you could have hundreds or even thousands of taxable events in a single year. And if you're not tracking every single one, you're underreporting. Have you been tracking every single crypto transaction, including swaps, staking, and DeFi activities? Most crypto investors haven't, and they have no idea how much they actually owe. Here's what makes this so dangerous. The IRS can go back and audit multiple years. If you've been underreporting for years, you could face penalties and interest on all of it. And with AI-driven audits, they're catching more people than ever before. Now, this next step I'm about to share with you is possibly one of the most important things to do when it comes to crypto tax planning, and yet it is one that people disregard the importance of the most, and it's understanding the moving abroad doesn't protect you. Problem number 4, the global reach problem. You can't hide. This is the mistake that catches a lot of international crypto investors. They think that if they move abroad or trade on international exchanges, their sales that happened in the US jurisdiction don't apply to them in a different jurisdiction outside of the US. But the reality is that the IRS has global reach. And if you're a US citizen or resident, you owe taxes on your worldwide income, including crypto gains, no matter where you live or where you trade. And with the FACTA agreement, also known as the Foreign Account Tax Compliance Act, and global reporting requirements, the IRS, underneath Treasury Department, can find you. We've seen clients who moved abroad thinking that they were safe, only to get hit with massive tax bills, penalties, and even criminal investigations when they tried to return to the US. Here's what makes this so dangerous. US citizens owe taxes on worldwide income. FACTA requires foreign exchanges to report the US account holders. The IRS has agreements with countries around the world to share tax information. Moving abroad doesn't eliminate your tax obligations. Failing to report foreign accounts can result in criminal charges. Are you a US citizen or resident trading crypto abroad and thinking you don't owe US taxes? Now that we have everything we talked about settled, the next step is by far the easiest process, yet most people overcomplicate it, and it's getting buttoned up for 2026. Solution number 1, track every transaction. Here's how to actually get your crypto taxes buttoned up. First, you need to understand that proper crypto tax compliance starts with tracking every single transaction. Use professional-grade crypto tax software. Don't try to track transactions manually. Use software like CoinTracker, Coinly, TaxBit, CoinWorth, or even CoinTracking. Import all your exchange data and wallet transactions. Reconcile everything to make sure nothing is missing. Track all transaction types. Trades, which are crypto to crypto and crypto to fiat. Staking rewards and interest. DeFi activities such as yield farming and liquidity pools. NFT purchases and sales. Airdrops and hard forks. And gifts and donations. Keep records for at least 6 years. The IRS can audit up to 6 years back for substantial underreporting. Keep all exchange statements, wallet records, and transaction logs. Document the business purpose of all your transactions. And oh, by the way, if you haven't filed taxes for a number of years, there is no limit on how far back the IRS can go. But even with perfect tracking, there's one more critical step that most people miss, and that's solution number 2. File all required forms and reconcile with the IRS. Tracking is only half the battle. You also need to file all required forms and make sure that your reporting income matches what the IRS receives from exchanges. Form 8949 and Schedule D for capital gains. Schedule 1 for other income like staking, airdrops, and etc. Form 1099-DA for reconciliation. FBAR, which is a FinCEN Form 114 for foreign accounts over $10,000. And Form 893-B for foreign financial assets over certain thresholds. Reconcile with exchange reports. Get copies of all 1099-DA forms from exchanges. Make sure your reported income matches what exchanges report to the IRS. If there are discrepancies, document why and include explanations. Work with crypto tax experts. Don't rely on generic accountants who don't understand crypto. Work with professionals who specialize in crypto tax compliance. Get a compliance review before filing to catch mistakes. The next part can take you from being someone who just files taxes to someone who optimizes and thrives. And it's something sophisticated crypto investors do automatically. And that's solution number 3. Plan for the future and optimize. Getting compliant is just the first step. The real power comes from planning ahead and optimizing your crypto tax strategy for the future. Set aside money for taxes as you go. Don't wait until the tax season comes to figure out what you owe. Calculate estimated taxes quarterly. Set aside 30 to 40% of your gains for taxes. Make estimated tax payments to avoid penalties. Consider entity structuring for tax optimization. If you're trading actively, consider structuring through a business entity. Business entities can deduct expenses that individuals can't. Work with professionals to determine the best structure for your situation. Stay updated on changing IRS rules. Crypto tax law is evolving rapidly. The new rules and enforcement priorities change every year. Work with professionals who stay current on the latest regulations. Plan for the next bull run. If you're planning to make serious money in 2026, plan your tax strategy now. Consider timing on sales for tax optimization. Understand the difference between short-term and long-term capital gains. Build a relationship with a tax professional before you need them. Crypto taxes aren't going away. The IRS is getting more and more sophisticated every single day, and the penalties for getting it wrong are severe. Every day you wait to get buttoned up, you're risking penalties, audits, and lost opportunities. Every mistake you make could cost you thousands in unnecessary taxes or penalties. But the good news is that crypto tax compliance isn't complicated when you understand the requirements and have the right systems in place. You just need to take action before the next bull run hits. If you have crypto gains, you need to report them if you want to make sure you're compliant and optimized for 2026. And if you want to build a tax strategy that lets you thrive in the next bull run, you need professional guidance. At Numeratus, we specialize in crypto tax strategy, compliance, and audit defense for high net worth individuals, and we even help with the reconciliation process for international investors. We don't just file your taxes, we help you build comprehensive strategies that minimize your tax liability while keeping you completely compliant. We're not your typical accounting firm. We work with serious crypto investors who understand that a proper tax planning is the difference between keeping your wealth and losing it to the IRS. If you want to learn more about how to get your crypto taxes buttoned up for 2026, how to optimize your tax strategy, and how to build systems that keep you compliant as regulations evolve, visit numeratus.us or contact us directly. Don't wait until the IRS comes knocking. The time to get buttoned up is now before the next bull run hits. Because remember, in crypto, the IRS is always watching. Make sure you're ready when they come calling.